Welcome back to Weekly. I'm chatting with David Rosenberg. David, before the break, you were explaining how you believe the U.S. is already in a recession and the Fed is undoubtedly going to cut rates this year, probably more than once, and they're going to continue to cut rates next year. Well, what does that mean for the U.S. dollar? Because when you look at the U.S. dollar, at least the trade-weighted dollar, as our viewers can see here, it keeps bouncing off its 200-day average. But then when you look at this next graph, the white line is U.S. 2019 expected GDP growth less the rest of the world against that same trade-weighted dollar. It's a two-year graph. The two lines are highly correlated. So if your call is right that the U.S. GDP is going to finally cave, does that mean the dollar is going to cave?
Well, the answer is no. The dollar is not going to cave because we don't operate in a vacuum. The global economy is going to cave along with the U.S. I think that your chart is great. It's just classically in the land of the blind, the one-eyed man is king, and the U.S. is the one-eyed man. So look, do you want to own commodity-related currencies in a global economic downturn? The answer is no. And that includes the Canadian dollar. But look, Australia has already started to cut interest rates ahead of what the Fed is going to do. Do you really want to own the euro, given what's happening with the friction with Italy right now and the prospect that they're going to move towards these quasi-IOUs? So we have a budget showdown and a much weaker economy in the euro area. We got Brexit. In the UK, so like, where are you going to go?
Something called Italy too, right?
Yeah. Well, that's what I was saying is that the euro's got an overhang, the UK's got an overhang. Commodities typically, look at the price of copper is down almost 10% in the past 6 weeks. Really, what's that telling you about the contours of the global economy? So if I'm right on this call, and look, this is a case where, as an economist, your assumptions drive your conclusions. My assumption is that we are entering into a recession. In a recession, you want to have liquidity on hand. And there's nothing more liquid. Well, for all the pimps, scars, and warts on the U.S., the U.S. dollar is the most liquid instrument on the planet. So you definitely want to have exposure to greenbacks.
So does it go higher?
It probably will go higher on a trade-weighted basis. If you're going to ask me, would I rather own U.S. dollars, say, or Canadian dollars, I don't actually have a positive view in the Canadian dollar in this economic forecast.
But I'm just wondering if the U.S. dollar goes high enough that we get into one of those emerging market crises again.
Well, we may well. I mean, look, the emerging markets are not a homogeneous entity, but there will be countries that have very high current account deficits, very high foreign debt denominated in U.S. dollars. They will run into trouble, but there's a lot of countries that will actually withstand all that. I don't think we're going to necessarily have a repeat of 2016 in that particular respect, but my sense is that that is an added risk, because what happens is that we could have an acute shortage of U.S. dollars in this environment. Okay, and this is exactly what happened. If you go back, for example, into that period in 08 and 09, you'd say, oh, well, the epicenter of the crisis was the U.S. Didn't mean you want to short the U.S. dollar, though, because there's a preference for liquidity and safety. And keep in mind that what is the one asset class that will gravitate and converge are going to be U.S. Treasury yields, notes and bonds. That's what you want to own. That will drive the U.S. dollar up. The big risk is actually going to be those U.S. equities and those U.S. companies that have high foreign exposures that'll be susceptible to the crimp on their margins from a rising U.S. dollar.
Like the large cap tech stocks. But let's just bring it back to Canada. What does your call mean for the Bank of Canada?
Well, look, I think the Bank Canada right now has a different forecast than I have, but that's nothing new. My sense is that they will lag the Fed. They lagged the Fed in the last cycle. I mean, ultimately, the Bank Canada cut rates aggressively in the last cycle, but they'll follow the Fed. You might have a near-term situation where interest rate spreads, those negative spreads, work in the Canadian dollar's favor. I'd frankly be selling into any rally in the Canadian dollar. But my sense is that, monetary policy in Canada, we are a price taker in monetary policy. We're not a price maker. So we will lag the Fed, but we will follow the Fed this cycle, basis point for basis point.
So ultimately, you believe that the Fed will cut rates to zero. Bond yields, of course, are going to collapse to below 1% for a 10-year Treasury. You have Draghi last week saying that he'll launch another QE. The most likely next move in rates is lower, et cetera, et cetera, et cetera.
Right.
How does this end?
Well, I think that, if you followed actually the Ben Bernanke playbook from that famous speech that he gave, the famous "It shall not happen here" speech, although it happened, in November 2002. His moniker is Helicopter Ben, right?
Right.
Why? Because he talked about helicopter money, debt monetization. That's the big bomb. But the Fed never used it. The Fed went with a whole bunch of acronyms, TAF, TALF, all the stuff that Bernanke talked about in '02, the Fed ultimately used in '08 and '09, by the way, including quantitative easing, which is now commonplace in the financial nomenclature. In fact, my sons know what QE is. Who knew what QE was before 2008? But I think this is going to end with a classic de facto form of default, which is going to be outright debt monetization.
So in other words, the U.S. Treasury issues a 100-year bond to the Federal Reserve, $2 trillion, let's say.
Or more.
Or more, okay. And the Fed holds the paper, and the Treasury's got $2 trillion to spend.
And they print the money. And remember, the U.S. has the largest printing press in the world, and the Fed gets its ink for free. So, but this will be coordinated, like everything is coordinated. QE was coordinated, the dollar swap lines were coordinated, going to zero rates was coordinated. This will have to be coordinated with the Bank of England, the ECB, the BOJ, or else the US dollar will truly fall out of bed. So this will be a global coordinated.
Ballpark, when does that happen? 2 years from now? 3 years from now?
In that time frame.
And so what does that mean for the stock market?
Well, I think you'd want to, I don't know what it means for the stock market writ large. I think that there will be segments, the hard asset component, the components that will be inflation protection will actually hold in relatively well. I certainly think that what's doing well right now, utility stocks are not going to be what you want to own. You want to own perhaps basic materials. You want to own consumer staples. But the stock market itself, it's really going to be uncertain as to how the stock market reacts to that. But I will tell you that what you actually want to focus on are classic inflation hedges, because we will actually, at that point, the Fed loses control of the monetary base. For all we know, velocity money will take off, and that will create the conditions for the next inflation cycle. So, in answer to your question, real return bonds, real estate, commodities, gold.
But isn't that another financial crisis?
They'll create winners and losers. But no, it won't be a financial crisis, because the way it comes down to your initial question, Andrew, is how do we get out of this mess? We have to inflate our way out of it. The problem with QE is that it created a ton of excess reserves in the banking system, but that money never got recirculated. The problem is that even as the money supply initially went up with all these central bank incursions, the velocity money kept on going down. Look where inflation is today. That's why these central banks are so fearful of deflation. Okay, it's because the real cost of debt and real debt ends up going up, and that creates the default experience. So really, inflation will cause some other problems, especially for those on fixed income, okay? We'll have to deal with it at that point. But the way you're going to forestall or prevent or lean against a debt default crisis is by creating the true inflation. And debt monetization will probably have much greater effects than QE did in that respect.